Have you ever wondered what all the fuss is about when the news talks about interest rates? It seems like a complicated financial term, but it actually impacts your everyday life more than you might think. From the mortgage on your house to the credit card you use, interest rates are a fundamental part of the U.S. economy. Let's break down what they are, why they matter, and how they work, using the Federal Reserve, or the Fed, as a prime example. So what is an interest rate? Simply put, it's the cost of borrowing money. When you borrow money, whether it's a loan from a bank, a credit card advance, or even buying something on credit, the lender charges you a percentage of the amount borrowed. That percentage is the interest rate. It's expressed as an annual percentage rate, or APR. Think of it as rent you pay for the privilege of using someone else's money. Why are interest rates so relevant to you here in the U.S.? Well, they affect major purchases. A low interest rate makes it cheaper to borrow, encouraging spending and investment. This is great if you're looking to buy a home, a car, or start a business. Conversely, high interest rates make borrowing more expensive, potentially slowing down economic activity. Let's look at some examples. Imagine you want to buy a house. If mortgage rates are low, say 3%, your monthly payments will be lower, making the house more affordable. But if rates jump to 7%, that same house suddenly becomes much more expensive each month. The same principle applies to car loans, student loans, and even credit card debt. Lower rates mean lower payments and less overall cost. Now, how do interest rates actually work? They're determined by a lot of factors, including supply and demand for money, inflation, and the overall health of the economy. But in the U.S., the Federal Reserve plays a huge role. The Fed is the central bank of the United States. One of its main jobs is to manage monetary policy, basically, controlling the money supply and credit conditions to promote economic stability. The Fed doesn't directly set all interest rates like those on your car loan, but it influences them. The Fed's primary tool is something called the federal funds rate. This is the target rate that banks charge each other for overnight lending of reserves. Think of it like a baseline interest rate. When the Fed raises the federal funds rate, it becomes more expensive for banks to borrow money. Banks then pass those higher costs onto consumers and businesses in the form of higher interest rates on loans and credit cards. Let's say the Fed wants to cool down an overheating economy. Inflation is rising too quickly, and they want to prevent prices from spiraling out of control. They might raise the federal funds rate. This makes borrowing more expensive, reducing demand and slowing down economic growth. Higher rates also encourage saving, as returns on savings accounts increase. Conversely, if the economy is sluggish and unemployment is high, the Fed might lower the federal funds rate. This makes borrowing cheaper, encouraging businesses to invest and consumers to spend. Lower rates also discourage saving, as returns on savings accounts decrease. The Fed's decisions aren't made in a vacuum. They analyze a ton of economic data, including inflation rates, unemployment figures, GDP growth, and consumer spending. They're constantly trying to strike a balance between controlling inflation and promoting economic growth. It's a delicate act. Consider a scenario. Let's say inflation is at 4%, above the Fed's target of 2%. The Fed might decide to raise the federal funds rate in small increments. This would increase borrowing costs, reducing demand and eventually bringing inflation down. But if they raise rates too quickly, they risk pushing the economy into a recession. On the flip side, imagine the economy is facing a downturn. Unemployment is rising and businesses are struggling. The Fed might lower the federal funds rate to stimulate economic activity. Lower rates encourage businesses to borrow and invest, creating jobs and boosting economic growth. There are other factors influencing interest rates beyond the Fed's control, including global economic conditions, investor expectations, and even geopolitical events. But the Fed remains the most powerful influence on interest rates in the U.S. So to quickly recap, interest rates are the cost of borrowing money. They affect everything from mortgages and car loans to credit card debt. The Federal Reserve influences interest rates by adjusting the federal funds rate. When the Fed raises rates, borrowing becomes more expensive, and vice versa. The Fed's goal is to maintain stable prices and promote full employment. Understanding these basics can help you make informed financial decisions and better understand the economic forces shaping your life. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.